Welcome to Module 3 of Global Finance and Electronic Banking. This is entitled The Exchange Rate Risk Management Strategy. So in this module, you will be assessing exchange rate risk management strategies used by multinational companies, describe the foreign exchange market. We will also analyze exchange rate forecasting and manage transaction, economic, and translation exposure. So these are the learning objectives. First is describe the foreign exchange market. Second, analyze exchange rate forecasting. And third is manage transaction, economic, and translation. So let's explore this first. What is foreign exchange? Or ito yung tinatawag natin na Forex or yung iba may makikita ka F at X. So this is the trading of one currency for another. For example, one can swap the US dollar for the euro. Foreign exchange transactions can take place on the foreign exchange market, also known as the Forex market. So the Forex market is the largest, most liquid market in the world, with trillions of dollars changing hands every day. So there is no centralized location. Rather, the Forex market is an electronic network of banks, brokers, institutions, and individual traders, mostly trading through brokers or banks. So how does this work? The market determines the value, also known as an exchange rate. So, naririnig nyo na yung word na exchange rate. So, it is being determined. So, it's the majority of currencies. Foreign exchange can be as simple as changing one currency for another at a local bank. It can also involve trading currency on the foreign exchange market. For example, a trader is betting a central bank will ease or tighten monetary policy and what that one currency will strengthen versus the other. So when trading currencies, they are listed in pairs such as US dollar and Canadian dollar, euro and US dollar, or US dollar and Japanese yen. So this represent the US dollar versus the Canadian dollar. So yun yung mga i-compare. Euro versus the US dollar and the US dollar versus the Japanese yen. So there will also be a price associated with each pair. Kunwari, yung Canadian dollar na 1.2569 is needed to buy 1 USD. Pag nag-increase siya to 1.3336, so ang cost na ngayon ng isang US dollar ay 1.3336 Canadian dollar kasi nag-increase siya. Kapag ganun, ang ibig sabihin nito, nag-increase yung value ng USD. Kasi from 1.2569 Canadian dollar before, naging 1.3336 Canadian dollar na to buy 1 USD. So, nag-increase yung USD, nag-decrease ngayon yung Canadian dollar because it now costs more Canadian dollar to buy 1 USD. So in the forex market, currency trade in lots called micro, mini, and standard lots. So a micro lot is 1,000 worth of a given currency, a mini lot is 10,000, and a standard lot is 100,000. So this is different than when you go to a bank and want $450 exchange for your trip. When trading in the electronic forex market, trades take place in set of blocks of currency, but you can trade as many blocks as you like. For example, you can trade 7 microlots. Pag 7 microlots, it's 7,000. Or 3 mini lots it's 30,000 kasi sabi nga pag mini lot is 10,000 each. So 3 mini lots is 30,000 or 75 standard lots. Ang standard lot is 100,000 pero dahil 75, 7,500,000 na yun, for example. So what are the factors that affect foreign exchange rates? So many factors can potentially influence the market forces behind foreign exchange rates. The factors include various economic, political, and even psychological conditions. So the economic factors include a government's economic policies, trade balances, inflation, and economic growth outlook. The political conditions also exert a significant impact on the forex rate, as events such as political instability and political conflicts may negatively affect the strength of a currency. So the psychology of forex market participants can also influence exchange rates. Now, let's discuss the foreign exchange market. So the foreign exchange market, it is also known as Forex, FX, or the currency market, is an over-the-counter or OTC global marketplace that determines the exchange rate for currencies around the world. So participants are able to buy, sell, exchange, and speculate on currencies. So foreign exchange markets are made up of banks, forex dealers, commercial companies, central banks, investment management firms, hedge funds, forex dealers, and investors. So let's understand it more. So the foreign exchange market was one of the original financial markets formed to bring structure to the burgeoning global economy. So in terms of trading volume, it is by far the largest financial market in the world. So aside from providing a venue for the buying, selling, exchanging, and speculation of currencies, the forex market also enables currency conversion for international trade settlements and investments. So according to the Bank for International Settlements or BIS, which is owned by the central banks, trading in foreign exchange markets averaged $6.6 trillion per day in April 2019. Currencies are always traded in pairs, so the value of one of the currencies in that pair is relative to the value of the other. So this determines how much country A, for example, country A's currency, country B can buy, and vice versa. So yon. So establishing the relationship or price for the global markets is the main function of the foreign exchange market. This also greatly enhances liquidity in all other financial markets, which is key to overall stability. So the value of a country's currency depends on whether it is a free float or fixed float. Pag sinabing free floating currencies, these are those relative value which is determined by free market forces such as supply-demand relationships. And while a fixed float is where a country's governing body sets its currency's relative value to the other currencies, often by pegging it to some standard. So pag free, nade-determine siya by free market forces. Pero pag fixed float, dinedetermine siya or sineset siya ng country's governing body. Examples of free floating currencies include the US dollar, Japanese yen, and British pound. So while examples of fixed floating currencies include the Chinese yuan and the Indian rupee. One of the most one of the most unique features of the forex market is that it is comprised of a global network of financial centers that transact 24 hours a day. So it closes only on the weekend. As one major forex hub closes, of course, another hub in a different part of the world remains open for the business. So this increases the liquidity available in currency markets, which adds to its appeal as the largest asset class available to investors. So ano yung most liquid trading pairs? So these are in descending order of liquidity: euro and US dollar, US dollar and Japanese yen, and British pound and US dollar. So, yan. So what is the size of the foreign exchange market? Let's discuss this now. So the foreign exchange market is unique for several reasons, mainly because of its size. Trading volume in the forex market is generally very large. As an example, trading in foreign exchange markets average $6.6 $6.6 trillion to ha per day in April 2019, according to the Bank of International Settlements, which is owned by 62 central banks and is used to work in monetary and financial responsibility. So the largest trading centers are London, New York, Singapore, and Tokyo. And these are the benefits of using the Forex market. So these are some key factors that differentiate the Forex market from others like the stock market. So there are fewer rules, which means investors aren't held to the strict standards or regulations found in other markets. And there are no clearing houses and no central bodies that oversee the forex market. And most investors won't have to pay the additional fees or commissions that you would pay on other market. Ano pa, because the market is open 24 hours a day, you can trade at any time of day, which means there's no cut-off time to be able to participate in the market. And finally, if you're worried about risk and reward, you can get it and out whenever you want. And you can buy as much currency as you can afford based on your account balance and your broker's rules for leverage. Ano pa? Let's discuss the trading in the foreign exchange market. So as mentioned a while ago, the market is open 24 hours a day, 5 days a week across major financial centers across the globe. So this means that you can buy or sell currencies at any time during the day. The foreign exchange market isn't exactly a one-stop shop. There are a whole variety of different avenues that an investor can go through in order to execute forex trades. You can go through different dealers or through different financial centers which use a host of electronic networks. So from a historical standpoint, foreign exchange was once a concept for governments, large companies, and hedge funds. But in today's world, trading currencies is as easy as a click of a mouse ng computer. Accessibility is not an issue. So, which means anyone can do it. In fact, many investment firms offer the chance for individuals to open accounts and to trade currencies however and whenever they choose. So when you're making trades in the forex market, you're basically buying or selling the currency of a particular country. But there's no physical exchange of money from one hand to another. So that's contrary to what happens at a foreign exchange kiosk. Think of tourists visiting Times Square in New York City from Japan. So he may be converting his physical yen to actual US dollar cash and maybe charges commission fee to do so. So he can spend his money while he's traveling. But in the world of electronic markets, traders are usually taking a position is in a specific currency with the hope that there will be some upward movement and strength in the currency that they're buying or weakness if they're selling so they can make a profit. Now let's discuss the differences in the forex market. So there are some fundamental differences between foreign exchange and other markets. First of all, there are fewer rules, which means investors aren't held to a strict standards na mention na to kanina, or regulations as to those in the stock, futures, or options market. So it also means that there are no clearing houses and no central bodies that oversee the forex market. And second, since the trade don't take place on a traditional exchange, you won't find the same fees or commissions that you would on other market. Next, there's no cut-off as to when you can and cannot trade. So because the market is open 24 hours a day, you can trade at any time of the day. So finally, because it's such a liquid market, you can get in and out whenever you want and you can buy as much currency as you can afford. So let's discuss the spot market. So spot for most countries is 2 business days. The major exception is the US dollar versus the Canadian dollar, which settles on the next business day. So other pairs settle in 2 business days. During periods that have multiple holidays such as Easter or Christmas, spot transactions can take as long as 6 days to settle. So the price is established on the trade date, but money is exchanged on the value date. So the US dollar is the most actively traded currency. The most pairs are the US dollar versus the euro, Japanese yen, British pound, and Australian dollar. So trading pairs that do not include the dollar are referred to as crosses. The most common crosses are the euro versus the pound and yen. The spot market can be very volatile. So movement in the short term is dominated by technical trading, which focuses on direction and speed of movement. People who focus on technical are often referred to as chartists. So long-term currency moves are driven by fundamental factors such as relative interest rates and economic growth. Another one is the forward market. So a forward trade is any trade that settles further in the future than spot. So the forward price is a combination of the spot rate plus or minus forward points that represent the interest rate differential between the two currencies. So most have a maturity less than a year in the future, but longer is possible. Like with the spot, the price is set on the transaction date, but money is exchanged on the maturity date. A forward contract is tailor-made to the requirements on the counterparties. So they can be for any amount and settle on any date that is not a weekend or holiday in one of the countries. Next is the futures market. A futures transaction is similar to a forward in that it settles later than a spot deal. But it is for standard size and settlement date, and uh, it is traded on a commodities market. So the exchange act as a counterparty. So let's have an example of foreign exchange. A trader thinks that the European Central Bank or ECB will be easing its monetary policy in the coming months as the Eurozone's economy slows. So as a result, the trader bets that the euro will fall against the US dollar and sells short 100,000 pounds, a euro dollars, as at an exchange rate of 1.15. So over the next several weeks, the ECB signals that it may indeed ease its monetary policy. So that causes the exchange rate for the euro to fall to 1.10 versus the dollar. So it creates a profit for the trader of $5,000 kasi bumaba. So by shorting 100,000 euro, the trader took the trader took in $115,000 for the short sale. So when the euro fell, the trader covered their short. It cost the trader only $100,000 to US dollars to repurchase the currency. So the difference between the money received on the short sale and the buy to cover is the profit. So had the euro strengthened versus the dollar, it would have resulted in a loss. So, ganyan maglaro ng foreign exchange. So, the key takeaways for this topic is foreign exchange is a global market for exchanging national currencies with one another. Foreign exchange venues comprise the largest securities market in the world by nominal value, with trillions of dollars changing hands each day. Foreign exchange trading utilizes currency pairs, priced in terms of one versus the other. Forwards and futures are another way to participate in the Forex market. And the foreign exchange market is over-the-counter marketplace that determines the exchange rate for global currencies. It is by far the largest financial market in the world and is comprised of a global network of financial centers that transact 24 hours a day, closing on the weekends. And currencies are always traded in pairs, so the value of one of the currencies in that pair is relative to the value of the other. Another topic is analyzing exchange rate forecasting. So using a currency exchange rate forecast can help brokers and businesses make informed decisions to help minimize risks and maximize returns. Many methods of forecasting currency exchange rate exist. Here, we'll look at a few of the most popular methods: the purchasing power parity, relative economic strength, and econometric models. So these are the three ways to forecast currency exchange rates. First is the power parity or PPP. So it is perhaps the most popular method due to its indoctrination in the most economic textbooks. The PPP forecasting approach is based on the theoretical law of one price, which states that identical goods in different countries should have identical prices. So, according to purchasing power parity, a pencil in Canada should be the same price as a pencil in the United States after taking into account the exchange rate and excluding transaction and shipping costs. So, in other words, there should be no opportunity for someone to buy inexpensive pencils in one country and sell them in another for a profit. So the PPP approach forecasts that the exchange rate will change to offset price changes due to inflation based on this underlying principle. So to use the above example, so suppose that the prices of pencils in the US are expected to increase by 4% over the next year, while prices in Canada are expected to rise by only 2%. So the inflation differential between the two countries is 2%. So this means that the prices of pencil in the US are expected to rise faster relative to prices in Canada. So in this situation, the purchasing power parity approach would forecast that the US dollar would have to depreciate by approximately 2% to keep pencil prices between both countries relatively equal. So if the current exchange rate was a 90 cents US per 1 Canadian dollar, then the PPP would forecast an exchange rate of this one. So meaning it would now take 92 cents US to buy 1 Canadian dollar. So it is one of the most well-known applications of the PPP method. So it is illustrated by the Big Mac Index compiled and published by The Economist. So the light-hearted index attempts to ensure whether a currency is undervalued or overvalued based on the price of Big Macs in various countries. Next is the relative economic strength. So as the name may suggest, the relative economic strength approach looks at the strength of economic growth in different countries in order to forecast the direction of exchange rates. So the rationale behind this approach is based on the idea that a strong economic environmental and potentially high growth are more likely to attract investments from foreign investors. And in order to purchase investments in the desired country, an investor would have to purchase the country's currency, creating increased demand that should cause the currency to appreciate. So this approach doesn't just look at the relative economic strength between countries. It takes a more general view and looks at all investment flows. For instance, another factor that can draw investors to a certain country is interest rates. High interest rates will attract investors looking for the highest yield on their investments, causing demand for the currency to increase, which again would result in an appreciation of the currency. Conversely, Low interest rates can also sometimes induce investors to avoid investing in a particular country or even borrow that country's currency at a low interest rates to fund other investments. So many investors did this with the Japanese yen when the interest rates in Japan were at extreme loss. So this strategy is common known as the carry trade. The relative economic strength method doesn't forecast what the exchange rate should be. So unlike the PPP approach, rather, this approach gives the investor a general sense of whether a currency is going to appreciate or depreciate and an overall feel for the strength of the movement. So it is typically used in combination with other forecasting methods to produce a complete result. Next is the econometric models of forecasting exchange rates. So another common method used to forecast exchange rate involves gathering factors that might affect currency movements and creating a model that relates these variables to the exchange rate. So the factors used in econometric models are typically based on economic theory, but any variable can be added if it is believed to significantly influence the exchange rate. So an example, as an example, suppose that um, a forecaster for a Canadian company has been tasked with forecasting the US dollar versus the Canadian dollar exchange rate over the next year. They believe an econometric model would be a good method to use and has researched many factors they think affect the exchange rate. So, from their research and analysis, they conclude the factors that are most influential are the interest rate differential between the US and Canada, the difference in GDP growth rates and income growth rate differences between the two countries. So the econometric model they come up with is shown as this one. So where the where these are the meaning of the formula. So after the model is created, the variables INT, GDP, and IGR can be plugged in to generate a forecast. So the coefficients A, B, and C will determine how much a certain factor affects the exchange rate and direction of the effect, whether it is positive or negative. So this method is probably the most complex and time-consuming approach, but once the model is built, new data can be easily acquired and plugged in to generate quick forecasts. So these are the key takeaways. Currency exchange rate forecasts help brokers and businesses make better decisions. Purchasing power parity looks at the prices of goods in different countries and is one of the more widely used methods for forecasting exchange rates due to its indoctrination in textbooks. The relative economic strength approach compares levels of economic growth across countries to forecast exchange rates. And lastly, econometric models can be considered a wide range of variables. It can consider a wide range of variables when attempting to understand trends in the currency markets. So that ends our module 3. And I hope that you learn in this module. So prepare yourself as you will be computing for the cost of capital of a multinational corporation in the next module. So enjoy reading and viewing. I have again added additional references and readings in the module. Thank you.